Broadcast is now starting. All attendees are in listen-only mode.
Hi there, traders. Welcome to Admiral Markets webinar, live webinar with Nenad and myself. So I forgot Nenad's picture there, but Nenad is joining actually soon. I will just finish my part about halfway the hour. Nenad's going to take over and explain his vision on Fibonacci. We already had first part. This is part 2 days ago on Tuesday. It is uploaded to YouTube, Admiral Markets YouTube channel. So feel free to check that out later on in case you missed that. Or if you're looking at the recording, you can take a look at both. So Fibonacci is a very interesting topic, really a great tool. But before we dive into that, be aware of these two disclaimers. The first one explains the fact that this webinar is shown to a global audience, but may not be suitable for everyone. Please visit admiralmarketsglobal.com. Select your country of residence and contact an appropriate entity to find out if this is suitable for you. And second of all, please note that trading for exchange and global financial markets is considered high risk. Please seek the advice of an independent financial advisor for more information on that. This webinar is for informational and educational purposes only. By continuing watching this webinar, you agree with this disclaimer and you are aware of the risk involved when trading. All right, so thank you so much for your attention on that. Let's continue. We talked last week about swings, about fib targets, ratios. So we covered all that. Just wanted to make you aware of what we talked about. Very important stuff, or aspects, I should say, better word. Let's move on to where we left off, basically. All right. So this is all we discussed, basically, on Tuesday. All right. Now, here we go. With regard to basically targets and sequence levels, I want to kick off and continue with that. Retracements and targets are great kind of indications of the levels that price typically goes to. So they work well for establishing turnaround points in the sense that price could stop and continue with the trend in the sense of retracements. So for instance, here down below, you see, for instance, a combination of a retracement fib, the 50 fib, and a target as well, the minus 61.8 fib. So in this case, we actually have confluence in a particular zone. Where do these fibs come from? Well, basically, one is placed from here to here. That's a clear swing, isn't it? And that's the 50 fib. It's about halfway that upswing. All right, so that's one level that is important. And then a fib from here to here, indicating the kind of counter trend swing, and the end of that ABC kind of counter trend swing to the downside. So when you have confluence like that, there's typically a decent chance that price will respond to that level. So fibs work very well for understanding when price could actually turn back into the trend direction, or when the trend could stop as it starts hitting these targets, the fib targets. So what fibs offer is really pretty precise zones, various areas where price could go to and could bounce, and therefore a very useful tool for trading during trends, and not so handy during ranges, because when price is going sideways like this, putting a fib on the upside, if you put a fib from here to here, well, that wouldn't work because price just went right through it. If you put a fib from here to here, it wouldn't work because price went through it. So fibs are very useful, retracements and targets, but it's very important and key to establish the right swing. And this is something we already discussed last week. But when you have the right swing, or you think that you have the right swing, and nothing is 100%, but when you have a decent experience in it, it will get better and better. It's a skill just like anything else. And you'll start to recognize when to use the fib tool and how. And when you do that better, you will be able to find these relatively precise zones, right? One zone is here, where there's the 38 and minus 272 target. Price went through that. The other zone is here. The next zone is here. One of these zones could be a bouncing spot. It turned out to be the second, not the first. All right. So nothing is certain. Price does not have to necessarily respond, as you can see here. Maybe price did respond a little bit because this candle does have a wick. So that indicates that as price was falling, it did bounce a little bit, but then actually continued. So this is a little bit the game that is played. Game is maybe a wrong word, but this is a little bit what happens basically, and this is what we have to be aware of and on guard for. So those levels might be respected, but how much and on which degree, right? On which time frame? On this time frame, the second zone was respected, and that also keep in mind that it was respected, but price broke a little bit below that, right? So although it is relatively accurate, it did push through a little bit as well. So that's why, in my opinion, waiting for candlestick reactions and counter trend lines or breaks above moving averages or fractals for trading bounces and breakouts in this zone is better. All right. Another approach could be a market order, right? Or sorry, a pending order right in that zone and put the stop loss maybe a bit lower. And that would have worked out well too. And there are traders that approach it like that. I'm not one of those. I like to trade to set up my decision zones, but then I want price action to confirm it, and I want price action basically to show bounce or breakouts in this zone before trading it. But that's my type of, that suits my personality more. And everyone has their own trading psychology and their own favorite approach. So that's something that is best discovered by each trader themselves or him or herself. So, but you can see that they do provide, a lot of good info there. And also candlesticks do provide some good info about when price reaches this zone. As you can see, there was strong bearish candlesticks. Maybe you cannot see it too well actually, but you just have to trust my word here that there are very strong bearish candlesticks with candle closes very much near the low as it approaches this fib confluence zone. So with such a bearish price action, that support zone is statistically not so likely to be used as a turning spot. But when price here starts to show bullish candles and it starts to slow corrective candles like this, then yes, more likely. And if it shows a very strong bullish candle like here, all right, breaking through that corrective zone, then yes, also the odds are turning that, and because the candlesticks, the price action is confirming the bullishness, that yes, things are starting to look a little bit different. And indeed, price action indicating the potential here for price to move up. So, for my opinion, Fibonacci retracements and targets, when using the right swing, are valuable levels for support or resistance, for bounce, and for breakout spots, and for targets. But I use it as a decision zone, not necessarily as an entry method. Sometimes as an exit method, yes, where I place take profits. That is something that is okay for me. I don't necessarily need to wait for candlestick reactions. Sometimes I do as well, but it's not a must. You can use it as an entry method too, right? But train it, practice it first, and make sure that it fits your trading style. It's not something that I feel comfortable with that much. I mean, sometimes I do, but I need to have more confidence in the setup. So I do it occasionally when I think that the setup has a higher probability, but I wouldn't do it for a setup that has average probability. That's my approach. It's not the only approach, as I already explained. So that's basically more info about fib retracements and targets in general. Just thinking if I wanted to add something here, but probably not. So let's move on to a new slide. Hang on. Hey. Sorry about that. Okay, there we are. Fib targets. Let's move on. So these are the levels I use. And while I use it maybe in a different way than many traders do, I'm not sure. I don't have statistics about which traders use what and how many, but I use it in the sense that I have one fib tool. I have basically 6 fibs, right? Not everyone has that. I already explained the fibs I use, fib retracement levels, I should say, in the last webinar. 23.6, 38.2, 50, 61.8, 78.6, and 88.6. And in the same tool, I add targets because you might have already wondered, you're mentioning retracements and targets. Yes, I have it on one tool. And I do that by adding minus figures to the tool. So that when I have a fib, I place a fib from here, from left to right, as Nena does. We both use the same method. So that when price retraces upwards, we are hitting the fibs like this. I know that some do it the other way around. That confuses me a little bit. I'm used to doing it this way. If you do it the other way around, that's, I guess, fine too. I mean, everyone has their own methods. I obviously am used to this, so I'll keep using this. So I have fibs like that, and then by using minus levels, they will appear below the swing. So you have a swing, correction, retracement, pullback, and continuation towards the targets. And it's all on one tool. These are the targets I use, and to me, they're worth gold because these levels are very, very, in my experience, very used, very accurate, and especially the minus 61.8 target is, a big level often when using the right swing once again. All right. How far price goes to those targets depends a little bit on the position of price at that moment and a little bit on wave patterns. Basically, when you're, not everyone is a wave analysis fan, of course, I understand. But if you do waves, then you do understand that a wave 3 will typically go to a further fib target than a wave 1 or wave 5. So if you have that ability to analyze wave patterns, that will be a kind of an advantage for you. But it's not the only way. You can use, of course, other tools of confluence to see what could be a fib target that makes sense by looking at other support or resistance levels, right? So you can use Murray math, you can use Keltner, Admiral Keltner channel, or Admiral pivot points weekly, which are part of the MetaTrader Supreme Edition that you can download for free from Admiral Markets. It's a unique plugin, especially developed by Admiral Markets, gives great levels as well, and you can use it in confluence with fib targets to see how far is it likely the price will go to. Or you can do some money management. You can say, okay, I take a little bit of profit at one target, but the rest I use a trail stop loss for. That's something are options that you can look into. I myself do use a trail stop loss, right? So if there's a good occasion for that, if it's a with the trend setup, if it's a counter trend setup, sometimes fibs are still useful, but then I would probably exit the trade at a TP. When is a counter trend fib useful? Well, for instance, here, where I have on the chart, you might not see it too well. Sorry about that here. But this is a swing, correction swing. It's counter trend, right? But there is some logic to putting the fib on the first counter trend swing at the right spots if you think there's going to be a bigger ABC correction. These are more difficult things to do, so you want to be on guard for that. You want to be careful with that. But if you gain enough experience, you'll find the moments where these ABC corrections do happen, specifically when their divergence patterns appear, maybe strong support levels here. So you want to find that confluence too. And then yes, these ABC corrections can happen. And yes, putting a fib on A, waiting for the B retracement and waiting for price to move to the targets of wave C has its merits and has its usage. As you can see, the targets again line up with Fibonacci retracement levels, and down price goes for a new low. Anyhow, I got a little bit distracted here. So yeah, what target do you expect? Depends also if it's with the trend, counter trend, what wave patterns, what confluence do you find using the support and resistance tools of your choice. All right, but whatever you choose as a support or resistance tool, whether it's pivot points, Keltner, Murray math, trend lines, fibs are always, I think, a useful addition. Fibs can always be added to that mix, in my view. And if you don't want to use it because you're not a big fan, eventually you think that it's too complicated with the swings, that's okay too, of course. But I still think, regardless, it's worth trying, gaining that experience and see if it's for you. Because I think a lot of traders do benefit from using the fibs retracements and also fib targets. What fib targets to aim for really depends on context. All right, so target and entry both depend on context. Context, where do you expect confluence? Where do you expect price to bounce? And the entry could be at those levels or after a reaction at those levels, a trigger like I do it. The stop loss is, so we talked about those two things. Now the stop loss quickly, and then I'll dive into fib targets a little bit more. The stop loss is if you want to use the technical point where the fib is invalidated as a stop loss, then the starting point for your swing is the technically correct point of your stop loss. Because if price goes through that stop loss, that means that that fib is not valid anymore. Unless you place a fib on a sideways correction. In that case, price could actually go to the bottom or top, but still respect 138.2 fib. All right? But besides sideways corrections, trends and ABC zigzags should not break the top or bottom, or otherwise the fib you're using is actually invalidated. So if you put the stop loss there, you're actually losing a setup, of course, but at the spot where your analysis is invalidated as well. So that would be a good spot to do that. If the stop loss, however, because you're using a larger time frame, is quite spacious, if the distance between your entry here and the stop loss all the way below this bottom is 500 pips, and it's a little bit difficult with your money management, right, for instance, then there are other ways of solving that by putting the stop loss closer. But you got to realize that you are kind of moving the stop loss into a terrain where price might hit the stop loss, take you out for a loss, but the trade setup itself is not necessarily invalidated, right? So for instance, you use a tight stop loss here, your trade gets ticked out, and the price still goes your way, our way. So it's a loss, but actually your analysis was correct. And if you would have used the technically correct stop loss, it would have been a win. So it's a loss, but your analysis was correct. And that can happen when you use a stop loss with fibs that is closer, like this. However, practically, sometimes it is better because of money management purposes or other purposes, perhaps. So in that case, for instance, waiting for candlestick reactions, for instance, or a break to put the stop loss closer is good so that there's less risk that price might tick you, hit you, and continue. Or we can use a stop loss below a very strong level if we see that the 61.8 fib, and there's a lot of bottoms and there's a lot of levels there. So we think that there's a low chance that price will go below it. We can go at 20 pips, for instance, or whatever below the 61.8 fib, depending on the time frame. Enter around here, target here, or here, or here, whatever, here. And it's still a good reward to risk ratio. That could have been a solution too, for instance. But there is that risk, of course, if price goes deeper. So that's one solution. The other solution is wait for price to actually respond, wait for price to break, then use a stop loss, roughly a few pips, maybe 15, 20, 10, depending on the time frame, below the previous bottom, right here. All right? So those are some options how traders in general can use stop loss for fib targets. Now, the next part, a few minutes here, it requires a little bit more time to go through all the specifics. But generally speaking, there's another way of using fibs besides fib targets, fib expansions, which I didn't dive into, maybe Nenad will, or fib retracements. I also use fib sequence levels, literally the number, the sequence of Fibonacci, right? So how I use it is by actually counting pips. So I take a top or bottom. So I take a top in a downtrend, all right, and I start counting the pips. So for instance, on a medium time frame, like 1 hour or 4 hour, basically I noticed that the sequence levels 55, 89, not lower than 55 for 1 hour chart. Anything below 59, 55 is too small. Have typically gained quite a respect with the market. And I notice also that when price starts to break below the third level, which is 144 pips from the top, that price, on average, from my experience, what I've seen, tends to accelerate into that direction. So, and you can see here that this space, this space, this space, those spaces tend to kind of price starts to move faster in those spaces. So what I do is I basically take the top and then I start to count and I say, okay, 1, 2, 3 are typically range levels. And I can expect price to accelerate to the fourth, and when it continues to the fifth, and when it even continues further to the sixth. Specifically between 3 and 5, you will see the most acceleration. And between 5 and 6, you might see a continuation, but a little bit slower continuation. So this example shows what I'm talking about. You see that the first 3 levels, price is relatively choppy and corrective up in here. But when price breaks through the third level, you see a pretty quick dash down to the fourth. The fourth level acts as a bouncing spot and makes a retracement. Now, in this case, it actually retraces to the third level. That does seem to happen regularly, but I wouldn't necessarily say that's part of the, part of this, a key part of that. It can happen that it does use the broken support as resistance, but it's not the main feature. Let me say it this way. So, but more importantly, once it breaks through the fourth level, you see a pretty swift move to the fifth. Then you see price making a correction at the fifth level, and eventually it does break below the fifth level, but it moves to the sixth, but a little bit slower, as you can see. I've noticed these patterns in the Forex market, at least. Not sure about other instruments. And I saw it on different time frames as well, daily and 15-minute. Now, for those time frames, I do use different levels. On a 15-minute chart, I use 13, 21, 34 pips is the third level. And on the daily chart, I use actually, let me think for a second. I think I use 144, 233, and then 377 as the third level. Obviously, because lower time frames basically don't need to move as much before they get into that impulsive zone, and daily charts, of course, are larger, so they need to move a little bit more before they get into that impulsive zone. Of course, test this first of all yourself, right? As always, don't take anything for granted. These are our experiences, our observations. Always, always try it out on a demo with your own testings and see if it's something that works for you or not. And maybe you'll bump into something and you'll learn something new that we didn't observe yet. And of course, let us know. We love to hear back from you and improve on our methods too. Feel free to do that. We are not shy of feedback. But so far, this has been a good target tool. Why is it a target tool? Because you kind of have an idea when price might accelerate. And it's not always like that. It's not a guarantee. Nothing is. But there's a good chance that price will get that acceleration. That's good to know, because if there's a good chance of acceleration, I'm more patient for price to move further. I'm more patient for price to go to a further target. Or maybe I know, price didn't break this level, right? So I'm going to be more cautious. I'm going to take profits sooner. And by the way, these levels do change a little bit. I should add, for pound pairs, these pairs tend to be more volatile. So for pound odd, pound yen, for instance, these pairs, actually, the third level, right, is actually more the fourth level. So price needs to break below the fourth level rather than the third. The third level is useful for euro dollar, Aussie dollar, slower moving pairs. Big, more moving pairs, typically the fourth level to the fifth and the fifth to the sixth is more important. All right, so a little bit there difference between pairs. Um, so it's good for me to know when should I be patient, when should I actually be less patient, and should I close a trade earlier, perhaps if in profit, or should I let it run, maybe hoping for one more push. So you can do this manually, obviously. Just take a top or bottom. Here too, looking for clear swing highs, swing lows, points, basically, and just calculate it, right? I personally am using a tool for that. So to make it easier, it plots these levels. So if you want that tool, feel free to reach out when the webinar closes and send an email, and I'll get back to you on that. But that's just out of laziness for me because it's easy. You can basically do this manually too, and just calculate the lines yourself. It's everyone can use this technique concept if they wanted to, but as I said, always try it out yourself. So that's about it from my point of view. I covered kind of the main ways I use fibs, retracement targets, sequence levels, but fibs, very wide concept. So there are many other techniques and ways to use it. Nenad is going to talk about that as well, about his views. But definitely think it's a very useful concept. So anyhow, that is my part. As I said, let's see if Nenad is with us now. He will continue with his second part as well of Fibonacci right now.
Thanks, Chris. As always, excellent introduction and explanation to all important things that we should actually know about expansions and about waves and the fibs. I will add a little bit more what I actually to my first explanation. So today I will explain a little bit more about IP patterns and about extra Fibonacci expansions, as I promised 2 days ago. So the first thing here is mentioning so-called IP patterns. Have in mind that I am not the creator of IP patterns, but rather it is Viktor Pershikov, a Russian trader who actually has his own book named Fibonacci Analysis on Forex. I recommend you to read it to get a further, deeper understanding if you want, of course. And these things were also published in I think it was a IFTA magazine in 2014. So basically they were publicly explained. So I'm not using anything versus his copyright, because this was publicly announced, and all these things can be also read in the book from Viktor Pershikov called Fibonacci Analysis on Forex. So to me, this looks interesting, and I need to say that I did some testing about these patterns, and I need to say that they are actually working. The biggest problem is, you will see, the biggest problem is basically it's a bit subjective, because when you draw Fibonacci retracement, you actually need to start from the right point. So it's a subjective thing. Picking tops and bottoms on IP patterns is also subjective things. But if you manage to pick a good top and bottom, or bottom and top, definitely this has validity, and I like how price behaves respecting these levels. So first, this is the first pattern. It's called IP1. So we will mark 2 points, L1 and L2. Okay, L1 is the point where the price needs to hit before it goes to L2, that is 9. Stop is above 0, target is 50 retracement, potential profit to loss ratio is 4.621. So let me show you the chart. I will be Very straightforward with this, okay, providing you with direct knowledge without any further ado. This is how we do it. First, as I said, you need to pick swings. My advice is always try to aim for the biggest swing. Okay, so you need first to see where the swing will end. When it starts to retrace, if it's, let's say, a big swing like this, or you have like double bottom, double top, something like this, you will see that it actually works. So my point is, I'm keen to use it on 1 hour and 30-minute time frame for intraday setups, and most of the time these levels, if picked up correctly, will be respected. So first of all, you need to draw Fibonacci tool, and this is MT4. On previous webinar I explained how to use it also on MT5. So we will add few levels here. First level that we will add is 0.09. It's actually 9 fib, okay, and we will add this percentage and dollar sign just to see the level displayed on the chart. Then we will add 14.6 that actually corresponds to fib 14.6, okay, and we will add these also these signs, okay. So when we press OK, now guys, you will actually see this is 9 fib, this is 14.6. Okay, I think I made a mistake. It's actually, just give me a few seconds. So go to fib, and actually this is 0.09, not 2 zeros. Now it should be okay. Yeah, so it should look like this. So this is your IP retracement tool. So we added 9, 14.6. These are not levels specifically used for IPs, but as you know, I'm a big fan of 78 and 88.6. So I tend to always leave it at charts. Okay, so you need to have in mind that 78.6 and 88.6 are always at my charts. Okay, if you have any question, please ask me. If everything is clear, then we can move on. So if you have any questions, guys, just do not hesitate to ask me. I need to make sure that you are actually following me. So yeah, I don't see any questions, so I assume that everything is clear, right? Okay, so you see how the pattern behaved. Let me remind you once more. First, the pattern needs to get to 23.6, then it needs to hit 9. Okay, target is 50, stop is 0. Okay, so we'll show this again. Price went to 23.6. Okay, then it hit 9. Stops are placed above, and it went for the 50. So this was a full. This was a fully successful IP1 on dollar yen. So the price went to 23.6, then it tested 9, okay, then it went to 50. So this is IP1. It's very important that you understand this, because you see, I will put the arrow here. So first, price hit 23.6, okay, then okay, it went to 9, and then it made straight to target. So I will just mark it like this. You see, so this was IP1, totally successful IP1 pattern. Now, as I said, the biggest problem with this approach could be how you can actually differentiate between, let's say, fib top and fib bottom. The main point is it's always subjective, but you can override it by using big swings like this. It won't work always if you pick up a minor swing, but if you are able to notice a huge swing like this, these patterns will work really to a high extent. So always try to aim for big retracements, as I'm showing you. Now, we can also try to find other IPs. IP2 is when, let me show you. So when the price gets to 38.2, then goes to 14.6, that is your entry. Stop is placed at 0, target is 61.8, profit loss 3.321. Okay, so now we go like this. Let's try to find an IP2. So let's say that you used this pattern. Now IP2 would start if the price didn't hit 50, but it actually stopped at 38.2 and went up for 14.6. So maybe now it will be a little bit tricky to find it, but let's see. Let's use this retracement. As I say, guys, always pick the biggest retracement. So you see, this is IP2. I didn't cherry pick this, so I'm trying to do it randomly, and you see how good they might be if you pick the right Fibonacci top and bottom. So price went here to 38.2, then it went to 14.6, and it hit 61.8. Let me mark this for you. So you see, it's very interesting. 38.2, okay, from this point, then 14.6. So this is your entry. As soon as the price actually hits 14.6, you enter, placing stop loss above 0, and ultimate target is 61.8. Now, very often, guys, you would need to protect your profits, because I also noticed that on intraday time frames, if you pick these big retracements, it will work out. But sometimes, you know, price might get here, then go up, and then hit your stop loss and proceed further down. So my advice is to actually try to protect your profits. If you enter at 14.6, use 2 fibs below to protect your profits. So if the price is going down, you just move your stop loss above 38.2. Once 38.2 is broken by, let's say, 3 or 4 pips. So it doesn't matter. For this example, we can use this fib to move our stop loss. For other example that we use here, as soon as the price reached and broken 23.6, we move our stop loss just above 23.6. So 2 fibs below or above, of course, depending on the direction, you move your trail stop. So for me, this is pretty much logical that you should definitely be using trailing stops when trading these patterns. Now, let's try to see a little bit more. Let's use this swing. Let's see if there was any pattern. So we now need to search for IP3. IP3 entry is 23.6 after the price hit 50% of retracement. Stop needs to go above 0. Target is 61.8, and profit to loss ratio is 1.6 to 1. So we need to see when the price hits 50, then it needs to go to 23.6. So let's see if we have any pattern here. So here we had a mix of, you see, this was actually 14.6. No, this was actually from this spot. If we pick up this retracement, it was a mixture of 14.69. You need to know that when price rejects 23.6 like this, I personally noticed that a lot of times price will hit also either 14.6 or 9 or something in between, and it will proceed further up. So it went like this, you see. So this could be, if we go fully with IPs, price rejected from 38.2, right, came to 14.6, and then it went a little bit higher than 23.6. So you see, this would have been good for 60 pips before price went down. So always try, guys, to protect your profit. So let's say that we should have moved our stop loss here. If we entered here, then obviously we would have protected our stop loss somewhere here. You can also try to search for all these patterns. As I say, they will actually appear very often, but it will take some time before you actually start noticing them. Okay, I will delete the old one. Let's see if we can find IP3. So the price hits 50, you see, 50 was hit, but it didn't pull back to 23.6. So from this perspective, valid IP3 would have been the price hit 50, okay, it went even to 61.8. We will talk about this, okay, it's actually IP4, but watch this, 50, then it went down, then it rejected from 23.6. So it should, before it actually reached this level, it should have gone to 23.6. So not down, but up. And then from this spot, we could actually see probably a nice drop. Let's see if we can actually find. If not, if it's not clear, guys, I will repeat it again. But the main thing is to actually, you need to search for all these patterns. Here again, you see price went to 50, it rejected here and still went down. So most of the time you will be searching for IP1s and IP2s. For example, here you see we have a valid IP1. You see IP1 and the price dropped. But it can be, as I say, tempting to see if the price will find IP3 or IP4. Like, for example, if you use this swing, you see this would have been qualified for IP4 actually. IP4 is price hit 61.8, then it reverses to 14.6, place stop above 0, target 61.8, 3.3 to 1 is risk to reward. And you see price hit 61.8, okay, then it went to 14.6. Now if we would have placed our stop above this level, we would have made some nice profits. Okay, so this is IP4. So 61.8, 14.6 entry. Price went here, it hit 61.8 on retracement, so your entry would have been here. This is your entry, and also this is the start of IP. Okay, so the start of IP, then price entry here. If you place your stop loss here, you would just need to move it when the price breaks this level like this, and you would have secured your profits. So those were IPs. I will show you the slides again, so if you have anything to add, please, if you have anything to ask, please do it, because we will move to Fibonacci expansion extra levels. So this is IP1, this is IP2, this is IP3, and this is IP4. So all this should be respected. It doesn't need to be literally to the pip, but sometimes you will see that the price comes very close to 61.8 and then reverses. You still can treat it as IP pattern. Okay, so still it means that IP pattern is valid. So don't think that it's not valid if it doesn't reject. Okay, now we move to Fib expansion. Okay, first level is 0.618. We will call it 618 FE, and usually it's a weak level, but once it's broken, it transforms into a strong support resistance. Then we have 100% Fibonacci expansion. It's also weak support resistance, but it is strong after the break. Then we have 123.6. It's similar to 61.8. Okay. Then we have 138.2, and it is a key level for direct pairs such as dollar, usually dollar crosses, like dollar yen, dollar CAD, dollar Swissy, where actually dollar is the base currency. 150% of Fibonacci expansion is 1.5, and that is a key level for euro crosses. Then we have 161.8 Fibonacci expansion. That is extreme expansion, 1.618, and also 200% Fibonacci expansion. That is also extreme. Now we will, I will show you how to add all these levels to your chart. Let's use, for example, dollar yen. Okay, so this is how we are going to do it. We will place Fibonacci expansion, so place it like this, and let's see that we use actually this swing. So you always connect your point A point B and point C with Fibonacci expansion. Point C is always a swing where you actually would trade. So point A in uptrend is the downward point, point B swing high, and the swing C is actually where you want to start drawing Fibonacci expansion when the price starts to reject. So this is how it looks like by default. We can also move it. Let's see here. And these levels are shown at the chart. You see here. Now, by default, these levels I say are 61.8, 100, and 61.8. In order to add more, you need to go to properties, to objects, list and properties. Okay. And edit. Now we add more levels. So we will add 1.382, and we will call it FE 38.2. Now we will also add 150. Okay. Okay, so 150. Now we will add, let's see, we have 61.8, so we need to add 200. Okay. And I think, let's just check it. You see, every important Fibonacci expansion is here. So we have 61.8, 100. Yeah, 120. We still need to add 123.6. So let's use this one again. 123.6. Okay. Add 1.236. FE 3.6. Like this. So now you have all important Fibonacci expansion levels. So let's go quickly through them. So when 61.8 breaks, first of all, this is not strong support resistance. But once it breaks, it becomes much stronger. So you can see the price broke through it. It was a retest, then another push and another push higher. So this becomes strong support resistance once it's broken. 100% is weak, but it also, similarly to 61.8, it can become strong once it's broken. Have in mind that it's not as strong on a break as is 61.8. 123.6 is similar to 61.8. Now we need to find other examples of a better uptrend, and let's use this on other swing so it will be more clear. So let's see, yeah, we can use this swing. Expansions are usually used as targets, while retracements are used for potential entries. So you see 61.8 was broken. Now this became strong level. The price went to 100, it rejected a little bit, then it went up. Again, this is stronger after the break, and this is much stronger after the break. Then price went to 130.8. As I said, it's key level for direct pairs. Before it went to 123.6, it's similar to 61.8. It becomes stronger after the break. Now this is the key level for dollar pairs. You see what happened after it was hit. The price rejected, guys. And this is very strong level. Again, the price went to 133.8 and 150. And it dropped again. Watch how much. So usually the price will respect these levels. 161.8 and 200 are extremes. Okay. For dollar, 150 is okay, strong. 138.2 is strongest. For euro crosses, 150 is the strongest. 138.8 is strong. You can also do it in downtrend, but let's see, for example, GBP dollar. This is now a downtrend. Okay, So let's use, for example, few swings in a downtrend from this level, let's say, to this level, okay? And we will put our swing point here. So Fibonacci expansion from this point to this point and ending our swing here. What happened? Price broke 61.8 and you see it couldn't make much above it. It went down, hit 123.6 and close to 123.6 and rejected again from 61.8. Just showing how this 61.8 is strong. Then the price went down again. It couldn't have broken much above 100, much below 150, and it rejected. So you see, these levels can be very good, guys, to actually give you an indication of potential retracement. So I, for example, did a pound-dollar trade today, and I made 50 pips by going long on a counter trend trade opportunity for pound-dollar. Now we see that our POC zone actually is rejecting the price, but because this is a strong downtrend, I assume that it can go even further to the upside. We still don't have a clear swing here, but now the price could probably go more to the upside because it already hit 150, and if this two candles that don't reject the price, it could go more to the upside. So this is everything that I had for you today. I hope that you enjoyed. If you have any other question, just go ahead and ask. For your information, this webinar is recorded, it will be uploaded. So here you can snapshot the screen, use it for any trading method, any trading system. I think this is useful knowledge. Have in mind once more that I used information from the Victor Pershikov book. It's called Complete Guide to Comprehensive Fibonacci Analysis on Forex. So for deeper understanding, you can read it. But the main point here, guys, I tested this. It works. Okay, it works. So I can testify that this is a good thing. So it's not a snake oil. It's not some stupid nonsense that people would try to sell you. This is good, but you need to practice it, and you need to actually be a little bit subjective when it comes to pinpoint the exact swings for Fibonacci expansion and Fibonacci retracements. If you manage to do it correctly, I think that this method can be applied to any existing trading method, and it's very good. Thank you guys for listening. As always, Chris and I with you here with Admiral. Cheers, guys, and trade safe.